I'm going to guess yes, we have. But that doesn't. There's still room now, though, for the market to go up between where the highs were and where we are now. So I'm always optimistic. I'm always long. A day like today, that's really not a good place to be. I have some hedges in place. But we've talked a lot about rates driving everything, rates driving the market, and how we've seen just, a major shift in interest rates. And yesterday didn't help, obviously, with the Fed saying, nope, we don't expect cuts. You're way off. We're taking 50 basis points of cuts off the table. That obviously didn't go over well. But the economic data today, as you said, a little bit hot. Could have used something a little bit cooler. But I think this is sort of follow through from yesterday. Like, oh, my God, we got an enormous debt problem, and we got an enormous interest rate problem.
Dan, you've had your eye on Nasdaq. What do you think is going to happen there? How does this play out? Are we at the beginning of a somewhat major decline here?
I think it could be. I mean, I think about the leadership, right? And so we know that Microsoft, Apple, these two stocks make up 20-some% of the Nasdaq 100. Tyler, that's an index of 100 stocks.
That's 100.
So two of them make up nearly a quarter of the weight. Okay, and if I look at both of those, and they're both down about 11% from their all-time highs made in the summer. They've broken some technical support. They're above the trend lines that have been really methodical on a 45-degree basis since their lows early this year. And I think you got to look towards the leadership a little bit. So that does exist in the Nasdaq 100. It's also where a lot of that positive sentiment in and around AI has lived in those mega cap tech stocks. So if that's kind of coming out of the market a little bit, then I start saying, okay, how is that equal weight S&P looking? Well, it's basically flat on the year. How's the Russell 2000, right? A bit more economically sensitive, more sensitive to tighter credit, that sort of thing. Well, that's flat on the year. So we're seeing some things under the hood across at least the stuff that I'm looking at that has been deteriorating. And it reminds me a bit of late 2021, where the major indices kept on making new highs, despite a lot of stuff under the hood not acting particularly well. And I think that's going on right here. So again, I'd say look to the leadership. Some of these technical levels are being violated here. And then ultimately, I just think with valuations, they're too high relative to where rates are and where I think a lot of folks are going to be more comfortable about where rates are going to basically, I don't know if you want to call it plateau, but find some sort of baseline in this near-term economic future.
Guy?
People watching this saying, wait a second, that's good news on the jobs front. Why is the market down? Because good news is bad news in today's world. That's just the way it is. And at a certain point, bad news is going to start to be bad news as well. So Karen's always optimistic. I love that about her. I am not. I was born in the Wall Street.
I love that about you.
And we love that about you.
No, but it's, but that's just the way markets work. But I'll say this on the optimistic side. Where we stopped today in the S&P is exactly where we topped out at in August of last year. So past resistance becomes support. That's a good thing. Here's the bad news. And we've been saying this for a while. At a certain point, higher interest rates are going to matter. And they're mattering today for whatever reason. Today was some line of demarcation that we went through. And rates aren't going to stop. And if rates start going back down, you have to ask yourself, why are they going down? And in my opinion, the only reason they will go down is because the stock market is selling off and there'll be some perverse flight to quality in the form of bonds.
Let me ask you, and then I'm going to ask you, Michael, where you think the 10-year yield tops out for this cycle.
I think
is it above 5%?
I know about 5%, but it's somewhere between 4.80 and 5%. I mean, we have broken out now. You mentioned it. These are levels we last saw 17 years ago. I mean, you can say what you want about the bond market. It's clearly telling a story. Karen talks about this all the time. It's not just about rates and where they're going in the Fed. It's about supply and demand. It's about the market is demanding a higher yield to buy our debt. Rightly so, by the way. The market is finally starting to call BS on an economy that has a debt to GDP approaching 140%. By the way, if you don't know, that's the United States.
That's the United States. Let's turn to you. I'll ask you, Michael, the same question. Where do you see the 10-year topping out for this cycle? And then we'll get into some more sort of substantive things.
Yeah, absolutely, Todd. I mean, I think the 10-year could get to 5%. That wouldn't shock me one bit. But remember, you're earning 4.5% on the 10-year today.
Yeah.
So if you get that for the next year and you get to 5%, I mean, it's a 0% return. It's not the end of the world, right? But certainly I think you go higher from here. I mean, listen, it's funny. I was listening to Guy, to Dan, and Karen. I don't know how I can agree with all three of you when you're all saying different things, but I actually agree with all three of you. I mean, at RBA, we're pretty constructive on equities, but not tech. Right? When you're at the bottom of an earnings cycle, which is different than Q4 2021, when you're topping out at the earnings cycle, right? And I think that actually could argue for a broadening of what we've seen on the Mag 7. And to Guy's point, I mean, listen, I'm a bond guy, so I was born and bred to be negative. You got lots of downside. We don't have a lot of upside.
Kindred souls.
So we're kindred souls, all of us. But listen, I certainly think the 10-year can go up. I think that's going to have meaningful ramifications for both equities and credit. And it's going to be about how you position, I think, from here out for the next 6-12 months.